everybody, welcome. We're just going to wait a minute or so to let people in the room, but you're in the right place. Okay, so hello everyone, and welcome to our next webinar in the Back to Basics series, Accounts Receivable. We are happy to have you here with us today. Before I introduce our presenter, I just have a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, you can hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the valuation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen, as sometimes the poll questions box pops up behind it. You may need to click and drag the Zoom screen around a bit to see it. If you're using multiple screens, check each one as it may pop up on another screen. If that doesn't work, you may need to disable your pop-up blocker. Now, I'd like to introduce our presenter. Vincent Parisi is a supervisor in LSL's Assurance and Advisory Department, where he specializes in auditing local government agencies, including cities, counties, and utility districts. He brings a strong understanding of audit planning, execution, and reporting, with a focus on compliance, accuracy, and efficiency. Vincent has experience in all phases of audit process and understands the common challenges finance teams face, especially during year-end. He enjoys helping clients streamline their audit process, improve their reconciliations, and build stronger collaboration across departments. Also behind the scenes is Ryan Domino, a partner in LSL's Assurance and Advisory Department. He'll be behind the scenes answering your questions throughout the Q&A, so feel free to put your questions in the Q&A box throughout the presentation. Okay, Vincent, take it away.
Awesome. Thank you so much, Rachel. I could not have drafted up a better intro myself. That was really good. Thank you. So overall for this training, we'll be really helping out for narrowing the focus of accounts receivable, as well as going through, common challenges, best practices. Also, there's a Q&A at the bottom. So if you have any questions, please send the message there and I'll do my best to look at them throughout. Most likely we'll get to that at the very end though. But just to go over the objectives of this training, we'll be going over the common challenges and pitfalls and learn how to avoid those. Number 2, we'll be going over what a reconciliation item is and learning a step-by-step approach for performing the AR reconciliations, as well as doing them efficiently and accurately. And then we're doing best practices and documentation for the preparation for your upcoming audit. Lastly, we'll be also talking about the collaboration between the departments within the government agency to ensure a cohesive approach for managing AR and due from other government activities. That last one is kind of necessary because sometimes there could be delays on the internal side for your own departments based on accruals and stuff like that. So we'll be touching on a quite range of ideas here. All right, so thank you for the intro again. Next up, we'll be going over the year-end close status. So in previous back-to-back or back-to-basic webinars, we have done the 87 and 96 calculation entries, or at least initiated the process. And then recently we have done the OPEB and pension. I believe that was a couple weeks ago. That was a good back to basics. And then obviously this one will be covering accounts receivable and the reconciliation process overall. Last item. So the next one will be on August 12th. That'll be long-term debt, accounts payable, and any accrued liabilities. That'll be on August 12th. I think that's in a couple weeks. So that one should be good as well. All right. So starting off, we'll just be going over a quick polling question. How many years of experience do you have with AR reconciliations? So we have A would be 0 to 2 years, B to 3 to 5 years, C 5 to 10, and D 10 plus. And if you are 10 plus years, you might have to share your screen next year because you have way more experience than I do. So I'll give you guys a quick second for that. All right. Let's see if I can hide that. Let's do 5. So, okay. All right, let's go next. All right, so this topic will be over the technical guidance of the area. So let me hide this really quick. Okay. All right, so technical guidance. Before we step into the step-by-steps of accounts receivable, we will be going over the general idea of what a reconciliation really is and the AR process overall. All right, so let's see. All right, so what is a reconciliation? It is a line item detail of what an account balance is made up of. For accounts receivable specifically, this will come in the form of a subsidiary ledger that you will see that is most likely behind the system. And that would be compared overall to the balance of that specific AR account and within the general ledger. So for this example specifically, let me hide this a little bit better. All right, so for this example specifically, it's kind of hard to see, but on the left, you'll see the account balance. So this one is the subsidiary ledger. You'll see the account number right here. And then typically you'll see the transaction line items. So, and that should be corresponded by a certain date. For this example, you'll see 6/30/2024 right here. And then it'll give you an overall description of what each transaction is displayed as. So for these ones, it could be governmental reimbursements for like grant activity, grant programs, or even like licenses, permits, anything like that. And then to the next column over, we got the beginning balance. This one is kind of necessary to tie out in terms of the subsidiary ledger, because if there is a variance, say you're in the 2024 audit and you see that $789 at the beginning balance, and there's a variance, say it was like 5,000 last year, that could be reason to cause a restatement. And that could be a financial and equity issue. So you really want to tie out the beginning balance as well as if that is like a small item. So for this example, the 789 right here, if that is a small item or like maybe 1 or 2 pieces, it'll be basically you want to have a documentation for whatever that is. And then so you can tie out like a specific invoice or whatever it is to that $789. And then to the next of that, we have debits. Obviously, those are invoices or any contracts that are associated. So for here, we have the $37,712. And then we have a smaller one for $50. And then we have the $81,000. So those really increase the AR balance there for that subsidiary ledger for whatever type of AR this is. And then you'll see the ending balance to the right of that, which is $118,645. And then what we do as the auditors, we have a little printout of the trial balance. So you'll see that right here, 118. Essentially, what we would do is tie that out to the exact dollar to the subsidiary ledger, and the client should as well. So whenever you're performing your subsidiary ledger, tying that out to the GL, it would be good to have like a variance mark to see what the dollar amount is if you're off, so you could go in digging into what the issue could be. For this example, obviously there's a 25-cent difference, but that's because we round at the very end on our end to the nearest dollar. All right, let's see here. All right, so next up, are your reconciliations really reconciliations? First, no, it is not a reconciliation. So this would consist of any subsidiary ledgers that don't tie back to the GL or any GL detail that consists of the entire year's activity. So essentially, we've seen as the auditors a lot of reports where they're like, oh, we provided the reconciliation, but it's really just a GL or a glorified general ledger in that sense. And we would immediately kind of send it back, asking for an actual reconciliation. All right, next up would be the yes, it is a reconciliation. This would be subsidiary ledgers that do tie back to the general ledger to the dollar. And then next would be if you have to verify that the account balance is actually correct on your end. And then if there is any AR, and you have to make sure that it is all accurate and current. So to highlight that last part, accurate and current. So even if you tie it back to the general ledger or the trial balance, you'd really want to do like a second level of review, whichever level you are. In reviewing any invoices and checking the dates, we'll get to that later though. You'd want to make sure that all AR is current and accurate. Let's see here. All right, so next slide is essentially the same slide, but we have two examples. Even though we saw that in the prior one, it was still a good example. As long as you have good documentation of what that beginning balance is, you should be okay. And then we have doesn't allow for review of those items to ensure they are still summarized, or sorry, ensure they are still outstanding like a general ledger. That does not allow for it. Example B, we have shows a year-end accrual entry that is summarized, and then however this entry can be pulled with ease and should tie 100% to the balance listed. So obviously, example B would be the best one for a reconciliation in the sense that you could drill into a specific transaction or a line item and be able to pull a journal entry for it. All right, let's see here. Let's see. Also want to note, if you do see prior year items, you'd want to get rid of those or at least document what it's for, potentially setting up a write-off or an allowance for doubtful accounts for significant items. All right. So here are the types of accounts receivable. We have utility billings, we have general, and that would be basically general government items, as well as due from other governments or grant receivables. On the utility billing side, you would see general proprietary revenue. So that would be like water, that would be sewer, that would be stormwater, refuse, and even like electricity. Those are typically recurring charges that utility customers incur and are essentially essential for the continuous operation of the service and for the city or district. And the typical type of revenue or I guess mapping or code you would see it under as would be the charges for services, but those would flow into AR indirectly. All right, next up, so that'd be general government. We have taxes receivable and we have special assessments. Special assessments in essence would be like charges to property owners for improvements on their building or their house or anything like that, as well as miscellaneous activity. And then for due from other government or grants receivable, I added this one in the sense that there's a lot of grant programs that we do see receivable balances, and it didn't seem fair to AR to leave this out because this is a significant piece. So you'll see federal or state agencies for grant programs, as you'll see grant awards specifically. So if you'll see a receivable amount within due from other governments or within, grant receivable, even unavailable revenue, which we'll get to, it'll be primarily because of grant programs. Let's see. And I do want to highlight, these are different types of AR. You'll see cash receipts, you'll see invoices. So that's what the auditor would typically request in this area. So you'll see cash receipts, invoices, contracts, or federal or state reimbursements for the governmental side. And then on the utility side, we would see utility billing statements, cash receipts for those billing statements, but primarily it would be the billing statements that we would look at to get proper coverage. Other items to mention, so say you have general, you just call it typical accounts receivable and it's taxes receivable, but it also includes federal estate. You might want to consider reclassifying to a separate accounts receivable account. So you would want to take out the due from other government, or you'd want to take out the grants receivable from that AR. So you can separate and have proper reconciliations. And so it's easier to classify certain items. I don't think you guys are going to mix up utility billing versus general revenues, but in that case, you might want to do that as well. Obviously, they're separate funds, so I don't think that's going to happen too much. Okay. Okay, AR best practices. So we have timely reconciliations. Our recommendation overall would be to not wait for year end. This would be a monthly process almost always, or quarterly. So the only reason why we put quarterly is if it's a really significant immaterial item, or it's very infrequent, a one-off item that you want to review, maybe like a grant program that you haven't received essentially ever. That could be done quarterly. But for the most part, we shoot for our clients to, I guess, reconcile every single month for all types of accounts receivable, as well as evaluating for allowance, which we'll touch on. And then the next one will be reconciling, not just identifying a discrepancy, but tying out the balances between the subledger and the GL. Obviously, we're going to touch on that the whole day, essentially. For segregation of duties, we have different team members responsible for the billing, the collections, and the reconciliation process. For this, you really want to have two separate individuals, bare minimum, for this process. So essentially, you don't want the same individual, billing out the customer and then collecting it. That causes a higher risk for fraud as well as higher risk for error. And also, it helps the city or district or whatever you are identify if there is an issue or reconciliation item. You could be able to fix it pretty easily and know who to talk to. And then utilize technology for efficiency. This one's kind of whatever system you have, you'd want to utilize it to the best of its capabilities. I know certain, softwares like Springbrook may have an AR aging attached to it, or Tyler Munis, whatever it is. You could print out an aging report based on the AR you have, but obviously there are system limitations and it doesn't capture all types of AR. So the key message really is to just utilize it to the best of your capabilities, and then consider looking for a better product in terms of efficiency for the accounts receivable side. And then for discrepancies, make sure to document the why and the how, as well as the resolution of the discrepancy on the subsidiary ledger. This is a good internal control to have, as the entity can identify riskier areas that might need revision in the AR process, as well as maybe, identifying something in the policy for write-offs or any allowance for doubtful accounts. Okay, next up, so common challenges and how to avoid them. First on the list would be the collections policy. This would be many times we see entities that don't have a collections policy in place at all. So suppliers are not held to the practice collection period because there's no policy in place. Essentially, you'd want to make sure the policy follows what you're trying to shoot for. Typically 90 days is a lot, so you'd want to cut off certain accounts within 90 days, depending on the type of utility revenue or whatever you have. You might want to set up separate policies for separate types of revenues of what is most likely going to be uncollectible. All right, next up would be long outstanding AR / not writing off. We typically always want to write off the old outstanding AR or establish an allowance. So if you have say a high percentage of utility, say you're not collecting even 10% of your utility revenues for water or something, it might be best practice, even if it's a small amount, just to set up an allowance for that account. And then obviously not reconciling AR, that's kind of the whole point of this presentation, but reconcile AR on a monthly basis or quarterly for minimal activity. So essentially you'd want to be timely with your reconciliations and have proper sign-offs and who reviewed them in time. So it's not just the preparation, okay, you just tied it out. It's more of reviewing as well as tying out those invoices and stuff that are outstanding. And then next up would be lack of follow-up or to receive payment. So send follow-up invoices frequently to customers monthly. So essentially you'd want to do it monthly, but there might be a time where you want to, ramp up the frequency of these follow-ups for these payments. So sometimes we've seen after a month or two, there's a customer that hasn't paid in such a good time, after a month or two, and then you might want to send biweekly follow-ups. And then if not, you're going to probably cancel the account after a while. And then for resolving payment disputes with vendors, follow up with the customer or on the discrepancies on a timely basis. This one is important. So if you have, it goes with the following up on the receiving payment. So if there's any discrepancies, you want to get that taken care of as quick as possible and escalate the issue to maybe the finance manager. If it's really they really don't think they should have paid that, then it should be back and forth there. But it should still be resolved within the month, just to make sure it doesn't roll over to the next period. All right, mixing regular AR with other receivables, making it harder to reconcile. So create separate GL accounts to track regular versus due from other governments, special assessments, or even miscellaneous. Like I said earlier, you'd want to really mix, you want to have those separated. You don't want to have your typical course of AR for your general fund to be mixed with miscellaneous activities or a one-time grant program, or even due from other governments, special assessments for property owners. It would be best to set up not too many GL accounts, but say you have like, 7 in your general fund, you might want to add a few more to separate those really one-off activities. And it helps your reconciliation process. It makes it a lot easier. Okay, so polling question number 2. What is the most common challenge you have experienced with reconciling AR? Using the GL as a reconciliation, it'll be combining AR into one GL account, not writing off any long outstanding AR, or all of the above. You might have more than one common challenge here. Obviously, it depends on your agency. So I could see not writing off long outstanding AR if there's like maybe if it's a water district alone and there's a lot of those outstanding pieces that just customers aren't paying. I could see C being the answer. This is all perspective based on your agency. All right, let's see. And then aside from the polling answers, if there was one that wasn't discussed or mentioned, go ahead and drop it in the chat. Now that you've shared with us your biggest challenges and we've recapped what the reconciliation is and what it does, I'm sure you may be asking yourself, what would the auditors do, essentially? All right, so this will be quicker. This will be a quicker section, but if there is one question, it is what are the auditors actually doing with accounts receivable? This is a common question we get, but this next slide will answer that for you. All right, so what are the auditors looking for? First step, it would be a reconciliation that actually ties to the GL. There's been a lot of times where we, the auditors, would see a variance from their main accounts receivable account, and it would be a significant variance. And then we would essentially send it right back. If it does not tie, an explanation of why with clear documentation would be necessary. Even if it is a small variance or a small occurrence, it is essential to document the issue because it might mean there would be a bigger issue going forward. So even if it's a small issue, you might see it across multiple types of AR. You might want to take care of those or at least try to solve them as quick as you can. And then at least document what happened, the why, and the resolution of how you fixed it for internal purposes and for the auditors you send the reconciliation to. All right. Review of AR aging and significant outstanding items. So 90+ days would be typical for any long outstanding items. Make sure when you send this to us or like whoever your auditors are, the first thing they might look at in the AR aging would be the 90+ day bucket. Even though the 0 to 30 or the 30 to 60 day bucket for the AR aging would be most likely more material. Even if it's a small amount in the 90+ day bucket, it would be a higher risk item because it is subject to management's judgment. It would be most likely a red flag for the auditor's eyes to look at those. All right, and then some common supporting documentation we have received when we examine accounts receivable receipts would be cash receipts, would be invoices, billing statements for utility billings, as well as contracts and grant awards for those common grant programs and due from other government receivables. And then review of any adjustments. This one's key. You'd want to do a proper review. So even if you have made all the adjustments, you have figured out what was really going on with those immaterial adjustments. Maybe it was a credit memo or a debit memo, which would be the overcharge and the undercharge of a certain invoice. Documenting the why and how it happened might help your process going forward. And then lastly, segregation of duties. This would mainly be done during the interim cycle. But when we interview for our revenues and governmental and proprietary, we always look at the segregation of duties. Like I said, for the billing, the collections, and the reconciling portion. All right, next up would be the LSL's approach to the year-end close. So this would be about the process considerations that we're going to talk about, as well as a step-by-step eventually. But it should be pretty smooth. I mean, these step-by-steps, you don't have to do it in order. It's just a guideline to start off. Let's see here. All right. So process considerations. So we have type of AR. Portions of the step or even sequence of steps may differ by the agency. So whatever you see here, it might not be the same for you guys. The type of AR your agency receives, maybe your agency doesn't have utility billing, or maybe even due from other governments, anything like that. So it's definitely personal experience. And then for the aging policy, financial software and how manual your report development is key. So knowing your limitations in your software. So for this example, there could be like, there are tools that you could use for your software capabilities like Blackline or Trintech. They can help you automate the process and matching transactions to invoices, identifying discrepancies, etc. So maybe consider having an AI tool or a software development program to help you identify certain AR. And then obviously the formatting of your report. So you'd want to look at certain software capabilities for that, as well as for a third-party collection agency. You want to know if you have significant outstanding items, you might want to think about a third-party collection agency and being able to confirm those balances that are significant and being able to increase your collectability. All right, so here's a step-by-step process. The first step is to review the aging report and use this as your opportunity to make sure the basis of what you're reviewing and reconciling is actually accurate. If you have to build an aging report manually, consider the type of AR, so utility billings, any permit modules, any regular accounts receivable, anything like that. Make sure you're showing your current balance and including your prior year balance, as well as documenting what that prior year balance is actually consisted of. And then highlight the items that are outside your policy. That would be necessary to see, and being able to track on the internal side what you guys need to correct. And remember, sometimes it can be helpful to build out a different version in Excel, different than the one that your software is printing out. I know there are software limitations that could be printed out from these reports, so just be cautious of those. And then obviously, again, it would be investigate any discrepancies in the balances. So we have duplicate or missing invoices can be a common discrepancy found. Obviously payments, maybe double payments, any adjustments. Like I said earlier, this could be a debit or credit memo, which would be the overcharge or the undercharge. So say your invoice was like $5,000 higher than what you actually received and the customer was actually accurate. Then you would do a credit memo to lower your accounts receivable balance to correct it to what it actually should be. And then obviously the write-offs. You'd want to make sure your write-offs are clear and consistent year over year. Just make sure that you have a policy behind it, essentially is what we're trying to get at. You'd want to be able to have a policy for allowance for doubtful accounts for those significant items. And then for those write-offs, those one-off write-offs that have just been sitting on your books for such a long time, you could document like, oh, we're looking forward to adding this to our policy for the 90 plus or maybe even 120 plus day bucket. Okay, so this is an example of an AR aging. Not going to spend too much time on this slide, but wanted a visual of how it should be done. So essentially, it's kind of small on my screen, so I'm going to look up here. But to the left, we have California volunteers. This is one of the samples from one of our clients. Essentially, the customer account number and name would be on the left side here. And then we do have the customer number here. So essentially, it's the same information as the client information. And then we would have the overall balance right here. So 245K for this example. And then we would basically say what fund it is. And then it would list out which bucket it falls under. So for this California Volunteers client, all of that amount was sitting in 30 days. So this is a current piece. So it's not most likely not going to get written off anytime soon. And then if we go further down, this one's 101. The full balance is sitting in 30 days, which is good. 4,000, that's good. As you see in this one's a little bit delayed. So Citation Processing Center, we have 28,000 is the overall balance. And then we have 14,200 of it is over 120 days. But in this example, it seems like half of it was, or close to half of it was written off already. So they're putting 14,200 still there. And then it seems like they allocate this balance across the funds. So if they still don't receive this 14,200, which has probably already been written off, they might want to do another write-off maybe in another month or so. That's what it seems like is going to happen. And then for this example, last example would be the Pines Restaurant. They had 8,300 essentially outstanding, and it was all over a month due. So essentially, if it was June, it'd most likely be like an August payment whenever that would probably be like a 30 to 60 day window outstanding. So it'd probably like an April invoice sent out most likely. All right, here's another example of the same example, essentially. As you see on the left, when I brought up that 17,589 per the aging report, essentially that was not the full detail. Even though an error aging model is very, very helpful, there was more detail, sadly. But sadly, the software actually couldn't print out all of how much was outstanding. And that's because of these accruals. So you see on the right here, there's a listing of like TOTs, any charter franchise fees, it seems like a general receivable account that hits the same GL account. So essentially, this 17,000 from the aging is most likely a specific customer they wanted to track. And then this detail is typical standard business operations for the city. And then it adds up to the total, which this in theory will tie to the GL. As you'll see in your own AR aging or any other software, most likely they're not going to capture accruals because those are last second items that are just posted directly to the general ledger. And the system for the AR aging will not know what that is. And that's fine. Even though that your AR aging does not capture literally everything, it's still okay to track and then at least document where you got the information from. So like for this example, the client said, okay, note one is most likely the AR aging model. Note 3 is most likely this module that is not in the AR aging. So they reference both documents, which is really good. Okay, step 2, review AR for any write-offs. Consider your agency's policy on the AR aging and write-offs. If you don't have one, now is the time to develop one. I'll probably say that again. But that's really key to make sure that the whole city or district or whatever is on the exact same page of how to get things done. And then review the aging of the AR. Like we just showed you, if that was your client, you'd probably want to look at that past 120-day bucket, stuff like that. Identify any overdue or any uncollectible accounts that need to be provisioned off. Essentially, you'd want to also talk to a third-party collections agency for the third bullet right there, just to make sure that you guys can also confirm the balances of those significant outstanding pieces. A third-party collection agency will actually help you out with that. Okay, step 3. So we have reconciling the AR ledger and the GL. So reconcile the AR ledger with the GL, which shows the total balance of the AR for the whole agency, and then review the compliance of AR transactions. So while it should tie, your AR subsidiary ledger contains a sum of your AR account balances that should balance in the controlling account. So when you see your balance sheet, it should tie that specific account. If you're reviewing your AR trial balance and see the total is not balancing to the GL, there's likely a posting or other error you'll need to investigate and resolve. This one could be directly involved with maybe not even the subledger. You probably haven't even gotten it there yet. Maybe there was an entry that was accidentally posted to the AR control account mistakenly, stuff like that. And then obviously the last part, you'll note that we have included an additional key point, which is the compliance with GASB and GAAP. Luckily, they haven't announced anything too specific yet with accounts receivable. So that's good news. But since this step is one in the process where you're reviewing your transactions in more detail, it is always important to make sure you're following GAAP and GASB pronouncements. Okay, so here's another example from a different system just to get you guys a feel of what things look like. On the left, you will see the overall trial balance, which is essentially the GL account with the account description, as well as the balance. So you'll see, like, if I click next, it'll highlight the balance on the left. That's the trial balance. And then on the right side, so you'll see those amounts. I could barely read it right here, but we have 11,600. We have 11,049. We have 2,205. Essentially, those from the trial balance, you'd want to tie that out. That's the next step. And then you see the column on the right. So this one's the AR subledger, very similar to the one I just showed you, but this is just from a different client, different system, different everything. So it can look different. So everything could be the same, but looks different. So that's fine. On the right, you'll see a little sum right here for 11,610. This is the AR subledger saying, okay, all of these invoices or all of these journal entries agree to 11,610. And then you'll see on the right the variance, which we'll get to. With these nice little arrows I have for you here. Basically, it sums up the different type of AR we have. So this one might be, licenses and permits. This one might be just general government. stuff like that, accounts receivable for like miscellaneous activities, etc. And more errors for you. There we go. Okay. Step 4 would be the reconciliation statement. I'm sounding like a broken record, but what is a reconciliation statement? A work paper or a comparative statement showing the reconciliation in the accounts or of the accounts receivable ledger with the GL and explaining any differences or discrepancies. So you pulled your aging report, you reviewed your aging report, you've reviewed your write-offs or consulted with a third party. General ledgers, not just identified the issues, but you've noted what the solutions are. Now you have to prepare that statement. And what would that look like? You may ask. This is going to show the reconciliation of the AR with the GL. And it's important to understand and remember the purpose of this exact statement. This is your work paper that it's for the auditors, it's for the client, it's for all tracking purposes, essentially. And make sure to define that case for staff turnover. If there's any staff turnover at your agency, this might be one of the first trainings to show, just to get the reconciliation process smooth and continuing. And then obviously the appropriate sign-offs, make sure the appropriate person is actually doing the reconciliation instead of the person who's doing the billing or the collection pieces of it. All right, so here's another example of a reconciliation statement. So if you see at the top here, we have, it seems like just general utility billing. So it seems like these are specific customer accounts up here. Everything might look different to you. So this is just another example. As you see here, we have licenses and permits, which obviously wouldn't go with utility billings, but they might have everything in just one manual Excel, which is totally fine. If they're able to reconcile to the GL or the trial balance, everything should still be fine if we're able to track it as the auditors. And then as you see here, you see the reconciling items. So these are typically items that are not in the aging. So you see the balance per aging for their system. It totals 56, but in terms of the UB aging report, 405. Additional reconciling items, like I said earlier, this is how they track the accruals. So we have the 36K, we have 4624. We also have 13K. And then lastly here, this is a good documentation piece for any adjustments. So this one, they wanted to remove this from the aging report because they did not honor the payment agreement. They most likely writ them off. So this Cadiente 1079, they removed from the ending balance. And then at the bottom, you see there's a GL codes here that tie those out. As auditors, we would do another variance check at the very bottom just to make sure the AR balances actually agree as a third check. All right, step 5 would be to resolve any discrepancies. Remembering what we just depicted on the prior slide, you will now need to resolve the discrepancies and make any adjustments on the reconciliation and timing issues. This is key since the AR aging won't typically have all the accrual entries or any at all. You'd want to do, it seems like a lot of manual work, but it is necessary. This is why the first reconciliation I showed you had a sub ledger and it added onto the AR aging to tie to the general ledger. And then let's see, no timing issues. Sometimes it's accruals and sometimes it'll be cleared out in the next fiscal year. So a lot of invoices might be there at the end of the reconciliation that were just sent out, like literally the last day of the fiscal year. And then accrual entries may not be on the aging again. So note that the items have to be clearly documented after the aging of what is not there. All right, lastly, collaborate with the departments if applicable. I already kind of touched on this, but essentially there are so many different types of governmental or proprietary revenues that you want to reach out to those departments internally to get a feel for how many things are outstanding. So like you might want to send one, like send a request or an email to one of the department managers, say like in May, just to get a feel for how June is going to look for the accruals. And then after June, you'd want to get a final listing of all the necessary accruals, most likely in July. July or August is typically the time frame I've seen to get a feel for where the departments are in terms of grant funding, in terms of any due from other governments, any contracts, stuff like that. You'd want to be able to tie those out when they send you the information. Oh, here's the invoice. They're getting back to us. They're actually going to make payment soon. You could document that on your end. So like say we see, as the auditors, we see a material amount or whatever, and we want to select it and you're still working with the departments, in September, October, November, it might be too late by that point, and then it might be like urgently trying to get the information, which is not good. So typically, we've seen July or August being the last good follow-up to those departments to make sure that you guys get the information necessary. You'll see the same thing with a lot with AP and accrued liabilities, but we're not talking about accrued liabilities here. So basically collaborate with the departments on proper accruals. Okay, step 6 would be the most common missed step. So verify items in the AR balance and they are accurate and they are current. Review the details to determine if the item should still be there. Like I said, like a million times, I'm sounding like a broken record, but if you basically perform the GL or the AR reconciliation and you tie together and you agree to the dollar without exception, that doesn't necessarily mean the job is done. There should be a subsequent review after the fact and making sure all the invoices outstanding are actually outstanding. Obviously, you'd want to look at the more material items first and then get down to the nitty gritty of like the $2,000 to $500, just so you could get the substantial balance substantiated and then sent to the auditors. As well as review the dates of the items and the types of transactions. This is important essentially for the dates because you might have sent the invoice in June, but maybe it's September and they still haven't sent the cash receipt yet. And then you might want to, we'll talk about this again later, but you might want to talk about the availability of that revenue and see if there's a reclass that is necessary. Let's see here. And then the biggest takeaway here is if you have like a total of $200,000 in accounts receivable, you need to confirm that the 200K is truly outstanding. And a good tip is to look at those dates as some questions to test the items you're reviewing, such as if there's an actual invoice or if there's a journal entry accrual, which can help inform what you're researching. So in theory, you'd want to see like those significant items. If we've actually canceled that out, maybe in the GL, or you're not able to find the receipt, you'd want to figure that out beforehand, like in July, before you guys send the final trial balance. All right, polling question number 3. What is an AR reconciliation? I like the word glorified, so I added it. A glorified general ledger, a glorified subsidiary ledger. C would be accounts receivable account total, so just the trial balance essentially. And then D would be the process of ensuring the subsidiary ledger agrees with the general ledger. I think the keyword there is the process for it. Give you guys a second there. Okay, we'll move on. All right, so like we said earlier, availability period, it is very necessary to review this when things are starting to seem a little bit late. Let's see, this would be one of the last steps in the AR process, at least from what we're telling you guys. Obviously, you don't have to go step by step in this process, but this might be the last step. Now, it's not all AR that is subject to this. It is only for the governmental pieces of accounts receivable, not necessarily proprietary. And this would exclude utility billings, AR, anything like that, any electric funds, any water funds. This is not to worry. So how do you approach this? You're going to need to confirm that all the subject receivables, in theory, posted to revenue and are available. So when booking to accounts receivable, we are booking revenue in order to keep it in revenue. It has to be collected within 60 to 90 days, depending on what policy you have or our audit perspective. So say you receive an invoice within, or receive a cash receipt from an invoice, like say it was a June invoice and it was sent, 2 months after the fact, the receipt, you might have some subjectivity based on your whatever your client is and how to, I guess, work through that with your policy. So there should be a policy that reflects how you guys record available revenue. And then once that step is complete, this work paper should be provided to the auditors, and we broke this out from other documentation, as it is not just a file or a report. This report should show your notes and review, confirming that you've completed the second evaluation. So when I say those dates, you really want to see past August, most likely, so September cash receipts. If they've basically posted those cash receipts late and you've received them late, most likely it's going to be transferred to an unavailable revenue. And lastly, those unavailable revenues would be common in grant programs. Obviously, like for the counties especially, you'll see a lot of unavailable revenue because sometimes some grants programs or like some state agencies, some federal agencies, they do take a while to get back to you. So they're not 100% they're going to receive funding within the next month or so. And that's fine. You just need to document it and put it as an unavailable if it takes too long. All right, continuing on the availability period. So the reason why we are discussing the availability period so much is because it affects the AR account overall. Even though this is an AR training, there might be some adjustments that move stuff out of AR because of this. Basically, if it's after 60 to 90, you're going to move it to unavailable. So this would impact multiple areas such as the federal CFA as well as the non-federal CFA. And to properly reconcile and track balance sheet grant activity, whoever's doing AR at your agency, you might have to work on the CFA a little bit, even though that's an expenditure report. You might want to be able to track the grant receivables for those specific programs, as well as any unearned or unavailable revenues. So they might ask for whoever's doing AR for assistance on how much is outstanding balance sheet wise. All right, so here's another CFA example. I'm completely drilling you guys on the CFA here, but here's a couple examples. This is a non-federal CFA, even though it says CFA. I'll just draw your attention to the top two, essentially. Here's a state grant. So it's the Alcohol Policing Partnership. This city or district or whatever, they recorded 18,900 in expenditures and then 14,000. So they had less in revenues, which implies that there is a receivable or an unavailable revenue. And in this example, they most likely received the remaining portion of that expenditures or the revenues. They received the remaining portion most likely after September. So say, for example, it was fiscal year 2025. They most likely received it or haven't received it yet as of September 2025. And then as we go to the next one, here's just a very similar example, but the opposite effect. California Library Literacy Services family. This one had 28K in expenditures, and then we had 9,300 in revenues. This caused a difference, obviously. So they had less revenues. They haven't gotten funded. They deemed that this was a $19,000 receivable. So that means they most likely received the money in July or August. So that's the CFA. I know it's not necessarily AR, but it does impact the grant tracking and reconciliation process of it overall. All right, let's see. Step number 8. So supporting documentation. Attach supporting documentation and evidence for the reconciliation. So this would be, the aging report, the ledger accounts. Specific audit evidence, though, would mainly be the bottom 4, which would be the significant cash receipts, which would be invoices, any utility billing statements, any grant awards. This would primarily be what auditors need to justify a certain revenue. Obviously, when you see utility billings, you'll see the statement itself, which is proper evidence, as well as the receipt for that. And then more on the governmental side, if we are seeing a receivable for a significant grant for like $5 million, whatever, you would most likely provide the grant award as well as the receipt for that grant once you do get the money, or like a bank statement copy showing that maybe $5 million of that went to this bank account. Let's see here. All right, so step 9, review and approve. Review and approve the reconciliation statement. Again, after all the discrepancies you think are solved, when you're preparing it, you might have to send it to someone higher up. So like a finance manager or finance director, they would also do a subsequent review. And most likely they're going to skim through those significant pieces and significant dates. So if they see like a July 2025 invoice, they're going to know that's not a receivable because the revenue wasn't incurred in the proper period. And then any findings or issues. So we'll have document the reconciliation process and any issues or findings that come about. Again, if there's like a $5,000, variance, and you really can't figure it out, but it's time for the audit, don't just leave it blank. At least like have a documented reason. We're still trying to figure this out. We think it's from this source. We're still trying to figure out what happened with that entry, anything like that to see. So we actually understand the thought process of the city, the district, or whatever it is. And then lastly, if there are any issues or findings, note and report them as appropriate. Now let's see. All right, polling question, another one. All right, how often does your agency review your AR aging? Never, ever. I put that one in there. Annually, quarterly, monthly, or daily. Hopefully not daily. That would be not ideal. Give you guys a second there. So, all right, so just a little recap. If there's one thing to grab from this, it most likely is this slide coming up right here. So best practices and a recap. It kind of just summarizes all the words I've been saying over and over again. Timely and regular reconciliations. Just don't wait until year end, please. Reconcile regularly to identify and address discrepancies promptly. Ideally, this would be a monthly process. And then lastly, if it's really immaterial or really like a one-off item, maybe a grant program, it could be quarterly, and that's justified. But if it's those higher, like transaction volume receivable accounts, like the ones we've been showing you in the snips before, you might want to spend more time, I guess, monthly and have the review done in a shorter amount of time. So monthly. Actual reconciliations. This would be no GL details. We'll still most likely see this as auditors quite frequently. This one's tough to avoid because some systems just don't allow reconciliations. But the point of the training would kind of to help gear you towards establishing one on your own manually. It doesn't have to be this, overcomplicated thing. It could be very simplistic. At least it helps the auditors and internally of where things are going and if things are appropriate for that classification. Segregation of duties. Assign different team members to invoicing and reconciliation to help identify the errors and prevent fraud. So again, billing and collections, you don't want the same person doing those typically. Unless it's a very small entity with maybe one individual overall, then you really can't avoid that. But maybe have someone like the city manager, take a look at it, or the assistant city manager, someone outside of finance, just like to have their knowledge, I guess, boosted up in accounting terms. So next up would be utilizing technology. Use the software to increase efficiency in the reconciliation process. Like I said earlier, use it to its max. It's really helpful if you could print an AR aging. Obviously, it's not going to be perfect. There might be agings that doesn't take a certain type of receivable. You'd have to do it manually. But just utilize it to its max, and then it could be very helpful. So there's not much legwork every single month when you're doing this. Again, collaborate with departments. Reach out to them maybe right before year end, so like May or like mid-June, and then get a final listing of any accruals in July or August for those departments that have significant grant awards or any utility billings or anything like that are significant. All right, clear documentation. So if there are discrepancies and you can't avoid them, clear documentation will almost save you. It would help you at least understand what the problem is going forward, and the auditors would at least identify what was missed. So it actually helps both sides. It's not just like catch you like, oh, you got caught with this 5,000. It's more of like, okay, let's kind of help each other figure out what's going on. And then writing off old or long outstanding accounts receivable. The first thing as the auditor mind would say is like, if it's 90 plus days or 120, you're probably going to write off a good portion of that, or you should. So it would cause a red flag immediately. Let's see here. Anything else? Additional resources. So we do have LSL blogs on the accounts receivable reconciliations, as well as the governmental webinars, as well as the previous webinars at this link. And then next up would be our back to basics. So we have another one for Tuesday, August 12th at 10 a.m. Pacific Standard Time for accounts payable, accrued liabilities, and long-term debt reconciliations. That will be done by Jamie Lambert, who's a CPA, senior manager here. And you can sign up to register in the following email. And then any questions? If we can't get to your questions, because if time allows, we'll definitely reach out to you afterwards. And the slides will be available for you guys afterwards too. Let's see. And then for lastly, it would be the contacts. So here you guys go. I think that concludes it, but I'll take a quick look at the questions available to help with AR reconciliations. The ones I've heard for AR reconciliations that would help in terms of software, I've heard Springbrook. That one is a little dated, but I know Tyler Encode, Tyler Muniz, There are some AI tools to help, which I can't name off the top of my head. But essentially, there might be the software you currently have might be completely okay. It just might be a little bit of legwork to get you there. But from the ones I've heard, it would be Tyler. Even Workday they print out basically a reconciliation, stuff like that. And then will there be auditors finding in an organization writes off a large amount of bad debt in 1 year? I would say that one's subjective. It would be basically if it's a one-off situation and it was just such a significant piece, I wouldn't say it would be like a finding. I can't say that whoever your auditors are, they might have different subjectivity. But it totally depends on the situation. What type of write-off was it for? Was it on the balance sheet last year? Maybe it shouldn't have been. It could have been causing or it should cause a restatement, stuff like that. Let's see. Let's see, is there anything else? Deposit, unearned revenue, deposit liability. I haven't heard too much about deposit liability, but in the unearned revenue, obviously that is when you didn't spend the expenditures for like a grant program or whatnot. A deposit liability, I'm not too sure what that would be derived of. But essentially, what I think of as period of performance. So if you've spent the money or you haven't spent the money on a certain grant, but you've received the funding for a future expenditure, that would be unearned. Not too sure about deposit liability. All right, I think that should cover it. So thank you guys. Hope you have a great day, great weekend. Thank you.
Thank you, Vincent, for the great presentation. Just a reminder, everyone will receive the slides and the recording later today. So with that, we hope you have a great day. Thank
Thank
you.
you guys.